Good morning, everybody, and welcome back to Money and the Law, My FM 101.3, your hometown radio station with your two hometown guys, Jay Marsden from the Marsden Law Group, and I'm John Droin from Main Effort Financial. We're also joined by the Hollison Cable Access Television Supreme Allied Commander, Christian Bidet.
Supreme Allied Commander.
Christian Bidet. Once again, Christian.
Commander of all forces, Metro West.
Right, Christian, who is, he's not allowed to speak. He's had his larynx removed, and he's had a couple other things, so he doesn't speak all sign language.
Surgically altered for radio and TV.
Actually, because if he does speak, it's some kind of like deity voice that
Nice.
you know that influences people too much. So
This is God.
yeah, so
Yeah, God, it's me, Margaret.
this is
Yep,
Christian Bidet.
That's right. Nice.
All right, so we're here with that guy, and we're your guys. We're your guys who talk about anything money, anything law. We talk about on Saturday mornings, which is kind of a cool time to talk about it because everybody's awake. You're kind of refreshed from the weekend.
Well, I mean, let's talk about how the 9 o'clock time slot was not an accident.
No,
I mean, we have tested and retested, and we've tested.
We used to be earlier.
Multiple time slots. I think we started off at 8, which didn't work out well for me or you, for that matter. Then we moved to 9 because we felt like 9 was kind of like coffee time. You're into maybe your second cup. Maybe you're on the road dropping off some soccer players, picking up some soccer players.
You should be
right?
up by 9. You should be up and running by 9 o'clock.
You should be. If you're an adult.
Yeah, right.
If you're an adult who has maybe some family responsibilities and you're still in bed at 9 o'clock on a Saturday, the only thing I would say is
you did something wrong.
Yeah. Something wrong.
Check your notes.
Yep, that's right. But I mean, at that point, you should. If you're still in bed at 9 o'clock, you're either Rich Glenn, or you're
not to mention any Rich Glenn names.
That's right. Or you you maybe I don't know. Maybe you just should be up. You should be up at that point.
Glenn under the bus.
You should be up at that
Rich,
point.
Rich, you okay? Oh my
God,
that was a greyhound that just hit you.
Somebody put a mirror under his nose, right? I mean, you should be up at that point.
Right, you should be up no matter what.
Time to get up.
What time do I get up?
Yeah.
I get up between 5:30 and 6:30 every day.
Yep.
And I used to be earlier. Like I used to be an earlier guy, and I think COVID's kind of allowed me to get a little soft in my old age.
But sleep in.
Yeah, right.
Yeah, 5:30.
Yeah, 5:30, 6:30. If I sleep past 6:30, which I will every now and again, like if I'm in the 7s, that's a sleep in.
Yep.
Yeah.
And that's usually after your birthdays. Things like that.
Yeah. But I've always gotten up. Even before the Army, I've always was like I could never sleep in. I was never one of those kids who could like sleep till 9 or even in college. I was like, I mean, I wish I was sleeping.
Sure.
I would feel like, wow, I should be sleeping.
I could use some more sleep.
Yeah, exactly. But I never did. And don't get me wrong. On those days, I wasn't afraid to take a nap. I was later on.
Are you a napper? To this day, you a napper?
No.
Okay.
No. It would have to be an event for me to be a napper.
Yep, there you go.
I'm not saying I didn't take a quick nap this past St. Patrick's Day normally I don't. What about you? You nap?
I'm up early. I'm an early riser.
You're an early riser.
I tend to be up early.
The early bird gets the worm.
Yeah, they get a lot of things. Yep, they get to drink a lot of coffee before anybody else is up in the house.
They get to go to the bathroom
They get to
first.
take the dog out. Yep. And then I'm a big napper. I'm a huge napper. I'm not going to lie to you.
I'm a big napper.
Love it on the weekends. And I'm not even going to lie to you. For all those out in radio land, if you tend to roll through the office at some type of unpre-planned appointment,
you may catch me. Whoa.
There's a better than average chance that if my door's closed and there's a recording of a phone call being played on it, it might mean that I'm catching some winks.
Sometimes, there were guys in the Army. They swore by it. They were like literally when someone said, "Hey, take 5," they're like, "I will take 5 minutes of sleep," and that's how they were able to do their thing. So
yep. All the greats did it, from what I understand. So I'm a model myself after that.
All the great artists, right?
Great politicians. Yeah, but it's funny. When I was working out of the house. 2 o'clock is like that's the witching hour. It
knocks you down.
I either need
if you eat, right? If you eat lunch.
That's right. Just about. So 2 o'clock, I either need to get up and go for a walk, or if I have the dog in the office, I'll take the dog for a walk and move around a little bit.
Because if not.
But if I don't, it is bye birdie. And so I've been known to put the feet up. And so when I was working from home, was my point. The kids would get home, they get off the bus right around that time, and I was usually running out of gas, so I was ready for a little quick cat nap. So the kids would come rolling into the house, and the office was in the house, and it's got a big bay window, and the kids walk by the bay window, and there's There's
got
Dad.
his mouth open, snoring.
Slugging away at it, right? Getting the job done, right? Leaning back in his chair with his feet up, grabbing a couple quick cat nap. Nothing long.
Right.
No blankets involved, no pillows. Just a quick.
I'm not on the floor. I'm not under my desk.
That's right. That's right. I'm not moving in. I'm just a quick little cat nap, and then right back at it.
Yeah,
so.
my old man was a classic napper.
Yeah.
Oh, a classic napper. He was one of those guys who could fall asleep on command, almost like you hypnotized. Like
Sure.
you snap your fingers and he'd be, and he'd be down.
I tell you,
it's a gift.
It does something for you. It does something for you.
Oh, it does.
Yep, it does make a difference.
It puts some juice back in your batteries.
Yeah,
That's for sure.
Yeah. I'm not gonna have a cup of coffee at 2 PM. I'm not doing that because wherever you go for it, it's been sitting around for 6 hours.
You know what?
Anyway.
You know what?
Yep.
I'll still be tired.
Yep.
Yeah, I'll still.
Yeah.
It's funny because I do get tired. Like you, I get tired that time of day.
Yep.
And don't get me wrong. It's not that I wouldn't want to take a nap. It's just that my office there's no place to take. And then my house, there's always something happening. Right?
Yeah.
I'd love to be able to. But so what I would try and do is I would always try and schedule some kind of a call or something in the afternoon, because if I didn't, I'll be on my computer.
Well, that's one of the things you end up doing. You figure out, as your day goes through, what's the best time of the day for you to do certain things, right? Like, what do you, making phone calls, doing, operation stuff or portfolio stuff. You figure out what time of the day you're best for that. And I find no matter how many times I try to examine it, around 2 o'clock, I'm good for sleeping. Yeah. That's about what I'm good for. So if you want to drop,
but in your defense, because you've told me this before, you can work at night. You can get stuff done at night.
Oh yeah.
So at 10 o'clock at night, you can be like, I need to knock this out, because I have trouble with that.
So and when you wake up at 5:30 in the morning, you're like, cup of coffee, you sit down, I flip the laptop up, I get some stuff done. I mean, so it's it's not one of those. And when I went out on my own, that's what I wanted. Like, some people don't want this sort of integration of their work life.
Yeah.
I wanted that. I wanted the ability to go in, get some work done, go take the kids, bring the kids here, drop the kids off here, pick this up, coach that, come back, do some more work. I mean, I have no problem mixing that all together.
Right.
Other people want
have a couple beers with some buddies that swung by, right? Yeah,
that's right. But other people want like a wall. They want a wall between their personal life and their work life, and I just never wanted that. I don't
well,
see.
You gotta,
I don't see it as different. I don't see it as different. It's all one big journey, right? So.
Christian, on the other hand, there's no separation from work or play, because it's all work.
Well, and then he's got the gangster thing going on.
That's
so
right.
He's all kinds of stuff.
He's in that secret gang, that Holliston gang, right? Yep. He's one of the older guys.
It's an AV gang. It's big. Yeah. They're big. They get together. They make it happen.
They get together, take a lot of video, a lot of unsolicited. Yeah.
He's throwing some overheads up.
Right.
The old plastic overhead. He'd write some stuff out. Really kind of. That's what he shows.
Look for it on YouTube.
He shows his seniority.
All right. So what do you want to talk about today?
You get a little glint in your eye.
No, I don't
have
anything. I have nothing. I have something, but I'm.
So what I was going to throw on the table was this concept of estate planning and tax planning, and having a conversation around that.
Was this something that was discussed at Java with Jay?
No, it could be. That's a whole nother thing. That's a whole nother thing. We'll talk about that in a minute. But
I had a client, actually a mutual client of ours, ask me, say, so are you doing that? I'm like, no. Java with Jay that's just Java with Jay.
That's with Jay.
That's just
not
with
Java
Jay.
with John and Jay.
No,
it's Java with Jay.
Jay, we have to kind of have some kind of separation a little bit, but which makes it healthy, which makes our
relationship lights out. Yes.
Why we've been going as strong as we have. And she was like, no. She's like, oh, you're not. I go, no. That's Java with. That's strictly estate planning. And I said, make sure you get a good cup of Java for that. Not that you will get tired, but I said, no.
2 o'clock in the afternoon, which is why we don't do it at 2 o'clock in the afternoon. It would be watching Jay sleep.
Right.
That's not what we're doing.
Right. And then I said, yeah. I go, really? It's kind of cool. I go, but here's the thing. Our show, and we've said, this is kind of the fundamental cornerstone of our show, is that the stuff we talk about in general is actually kind of boring stuff. I'm not going to sugarcoat it. Yeah. So when you talk about,
well, no, it's boring to some folks.
It's
exciting to us.
It's exciting to us because this is what we do. It's our livelihood. Just like anything that you're really into, right? So, but to the average person, they may be like, really? Do you want to, how much can you tell me about a Roth IRA? And you're like, yeah, no, let me.
How much?
So much.
How much time you got?
Yeah. So the fun thing about our show is that you are here and I'm here, and we have this kind of playful banter to talk about some subjects that could be dry, right? It could be a little bit dry. It could be dour at some point.
To the untrained ear.
To the untrained ear. So that's our job, is to make something like, I don't know, estate planning or tax planning interesting,
exciting,
and
riveting,
borderline exciting, right?
Yeah.
Exciting. If you can get excited about, when you say, hey, do you like saving $5,000? Like, what
do you
would you
like
do?
money? Do you like having lots of money?
Do you like being able to to tell your heirs, or to tell your people that you're going to pass on your fortunes to, that everything's going to be okay, and that you will inherit this money, be able to do things, send your kids to college, and all this great stuff.
Right.
Do you like that? And the answer is, it's a rhetorical question.
Maybe
a rhetorical question. The answer is yes.
All right.
So that's why.
What were you thinking about talking about today?
That. Estate planning and tax planning. Yeah, no. Today's the law day. I do like Roth IRAs, but I do want to talk about estate planning. I do like the idea of the estate and tax, kind of like because they relate to one another.
They dovetail. Yep.
And we are still in tax season, so taxes are always always an exciting thing to talk about during tax season. Especially,
I was shamed by America's CPA today for not having my tax paperwork into him. Again.
By our superstar, rock star CPA, Mr. Alfred Adavasio.
Yeah, that's right. So he shamed me again today for not having my stuff in. So.
You know what, Adavasio, I will say this: he is a dear friend of mine. He's a dear friend of mine. But he is one tough guy to get a hold of during tax season.
He's one tough guy to get a hold of, but he's also one tough guy to it's literally shameful that I haven't got this done yet, and he's on me like a new suit.
But this is nothing. This is nothing new. This is not. Remember when you used to do your own taxes?
Oh, I do. You know when I did them?
Yeah.
Midnight, whenever they would do. Hit
I
and send at 11:59. Out the door they went.
Didn't send nothing. You were driving to the post office and sticking it in the mailbox.
This counts. Stamp this.
Yes,
stamp
it's good.
this.
It's good, right? It's good.
Yep. Remember those lists, right? Where are they collecting mail all night long?
Right. Where's the 24-hour mailbox?
You driving to the South Boston Postal Annex to get my taxes
because it mattered, right? Because it mattered so much, right?
Yep.
Yeah. Because if you put it in the day later, that's it. They're coming.
They're
coming. Guys in black hoods.
They're going to come looking for you.
Yeah. There's people rappelling down the side of your, kicking in that way. They're at 2:00. And they know, like, you'll be sleeping right when you fall asleep.
They show you a timestamp that they've had tattooed on their hand, so that when they slap you across the face with that late time.
They're like all the spec op IRS guys are out there and like, okay, he's down, right? All right, ready? Start the entry. They start burning like burning a hole in the window.
That's right. They're climbing through your building.
Yeah,
it's great. All right, quick break. We'll come back. We'll talk tax.
We'll talk
Very
super
exciting.
tax. All right, we'll be right back. See you. Don't go anywhere. Money in the Law, My FM 101.3, Hollis and Cable Access. Jay Marsden, John Drone. We'll be right back.
And we're back. Money in the Law, My FM 101.3. Jay Marsden with the Marsden Law Group. John Drohan, main effort financial Christian, steering us through the con. Shout out to the greatest. My other brother-in-laws may disagree with this, but shout out to the greatest brother-in-law in the world, Dan Higgins, doing his thing, just getting after it, making all that stuff happen. So shout out to him. Thought I'd reach out. So I know you're listening to Dano. So enjoy. Any questions? Just give me a call.
Dan's a big fan. He's a big
Money in the Law fan.
And here's the thing. One of the things that he probably hasn't said out loud to you is, because you guys are related by marriage, not by blood, he's a big fan of our show, but I think he errs on the side of money. I'm just
be objective.
I'm just saying. I'm just trying to be objective. But Dan and I, we go way back. Well,
Dan likes money. I know he errs on the side of money. Dan likes money.
Although we're adversaries on the softball field, Dan is a wonderful athlete.
Legendary athlete. Legendary athlete.
Yeah. A little too good sometimes.
Yep, I know.
But I
knows his way around.
He may have mentioned that he thought I was funny.
I don't think he ever.
No, I think he said
Never
that.
Never come up. Never come up.
Dan, we'll
talk about
confirm
it.
this
We'll talk about
offline.
it. Yeah, we'll talk about it later.
All right, so we're talking about estate and tax planning. So how do both of them? How do they kind of work together? So again, remember your estate plan is that's kind of like, this is I want to here's what I want to see when all the dust settles.
I want to
right?
get it from point A to point B. That's where I want it to go.
Here's what I want to see. I want to see.
Here's who I want to get what.
Yep. And of course, built into my estate plan is my retirement plan, because nobody really knows like when they're gonna when they're actually gonna move on to their shuffle
Great
off
reward.
that mortal coil.
Yep.
So first and foremost, everybody's you have to kind of retire and not run out of money, right?
Yep.
And so your estate plan is kind of built around that fundamental, that I'm not going to run out of money. And if there's money left over, and in many cases when you get through planning with them, there's always going to be money left
Always.
over. Or there's money left over because specifically your clients told you, like, yeah, you know what, I really do want to leave money to my heirs, to my children, to my grandchildren, whatever. And so they're, the plan is constructed around that.
Well, I guess it can be, and that's, when we talk about estate planning and when we talk about tax planning with clients, we try to, just like we do on this show, we try to say, look, let's just talk conceptually. Right? Because I think clients really, not prefer, but clients like to have a conversation about the concepts before they want to dive into the numbers. And what I find...
Because the numbers get you tired, right?
Well, the numbers get you tired. And what I find is, with other financial planners who are not as astute and as wonderful and as committed to the clients as you guys are, is in an effort to sort of prove themselves, if you will, they come running in with the calculator, and they start pounding on numbers to talk about, your estate. And a lot of it's a scare tactic, right? You're going to pay a lot of money in estate taxes, and here's how much you're going to pay in estate taxes, and here's how much your kids aren't going to get. And when your kids don't get that, here's what that money could have done. And and to your point, it is exhausting. Like that's creating stress, and stress is exhausting.
Yeah.
And stress is not good to help you sort of make a clear-headed decision.
And a lot of times those numbers are hypothetical numbers, right?
Absolutely,
those numbers
they
are projected numbers. And those, don't get me wrong, those are good numbers. You need to do that. You need to kind of have those kind of guidelines.
You need to have the concepts.
Yeah.
You need to know, you don't need to know what the numbers plug into. What you need to know how they work.
Yep.
Right.
Yep. You need to know, like, okay, so this is the window of what you might see. This is where this is the percentage of potential tax that you may pay, whether it be an estate tax, whether it be income tax, whether it be whatever kind of costs that are involved with this.
That's right.
You need to have like some ballpark numbers. And don't get me wrong. I mean, I love getting into the numbers.
Sure,
sure. And you do as well. I mean, I like saying, okay, here we go. At the end of the day, here are the real numbers. But you're not going to know what the real numbers are probably now. You're not for quite some time. So,
well, it depends on what your numbers are, right?
Yeah.
If you're 64 or 65 and you're just getting ready to retire, and you've never not worked a day in your life, and you really haven't sort of figured out from an income planning,
never not worked a day in your life,
right? But I mean, you've never figured out the estate, your income planning, and what that's going to look like, and what your lifestyle is going to look like. And are you paying for one house or two? Are you paying for airfare? Or are you driving? Do you have a boat? Do you have a golf club? You know what I mean? Like you haven't figured that out. So the first thing that we try to do, right? If you're going to write anything down about tax planning, the first thing that I would suggest you write down and star the daylights out of this, okay, is, all right, wait for it. It's the big secret. It's coming, right? Wait for it. Basically, do you care? Okay? That's the first question. Now, I'm not saying that to be cavalier and say it doesn't matter.
Yeah.
What I'm saying is, for the most part, and unless something changes, and it may, and we're not going to dive into whether or not the new administration is going to come up with some cockamamie. That'll happen when it happens. But the first thing that you have to ask yourself is, legitimately, do you care? Because for the most part, husbands and wives, something happens to them, full marital deduction. Spouse gets everything. Husband gets everything. Wife gets everything. Whoever passes away, spouse gets everything. You pay no taxes.
Yeah. So just to be clear, we're talking about estate tax right now.
Yeah.
So let me just back up 1 second for our audience, and then I want to talk about that. So when you talk about estate planning and the taxes involved, there's two kinds of taxes, right? There's there's estate tax, there's
Yep.
the actual estate tax, whether it be federal or state estate tax, and there's also income tax,
Yep,
right?
that's right.
Because if I'm passing on something that has never been taxed, there could be some income tax implications for the people that are. So right now we're talking about the estate tax, and then we're going to go into the income tax piece. But you're right. So and again, you don't want to be flippant about it.
No, and I'm not being, and I am not being flippant about it. I sometimes being a little bit flippant about it when you're explaining it to somebody it is done as a way to balance out that scare tactic that somebody else is going to throw on the table.
As opposed to giving it too much gravity.
That's right.
So if you're in a situation where you could potentially be facing an estate tax, and let's stay away from the federal estate tax, because those are
big.
Those are some
big numbers
much
right
larger
now.
numbers,
That's
and you and I really don't deal with that many people. I mean, maybe I can't really speak for you, but we only have about 50. No, I'm kidding.
Yeah, it doesn't come up a lot. Yeah. That's a good point. So basically, this is the state mass. We're just talking about the mass state tax world for the purposes of this concept.
Estate tax, right? And it's significant. It's a real tax. It could result in your estate having to pay some money, right? Having to write, maybe a good, not an insignificant check, right?
Yeah, well, that's part of the discussion. But anyway, the way it works for those of you who are paying attention is, if you pass away with $1 million in Massachusetts, more than $1 million, you got to pay estate tax.
Well, but $1 million in what though, right? Not $1 million in the bank, right? So no, but
$1 million everything. Yeah, $1 million everything. House, retirement, all that stuff.
Life insurance, right? All of it.
Yeah, it all counts, right? They don't give you a pass. Everything counts. So you live in Massachusetts, you live close to Boston. Your house, without even thinking about it, is worth $500,000, right? So you get there kind of quick. So the point is, if something happens to you or your spouse and the money's coming back and forth between husbands and wives or spouses, they don't care about that. The state doesn't care about, you can leave your wife $10 million and Massachusetts doesn't matter. You can get $10 million from your wife in Massachusetts, doesn't matter.
Right.
Complete exemption for marital planning purposes. So no taxes. But the challenge, of course, is when the second person passes away, or the second person to pass away leaves it to the kids, for example. That's when the tax kicks in. That's when the estate, because now you've inherited $10 million,
right?
and that's where the estate tax in Massachusetts. If you have more than $1 million, you're going to file a state tax return, and that's where the state puts their hand out and says, somebody owes us some money, okay? And then that brings me back around to my original comment, which was, remember, for the most part, you will never write that check.
No.
That check will be written by somebody who is other than you, okay? And so what we always try to sort of start off this conversation with is to say to our clients, let's think about that.
Yeah.
I'm not saying it's going to drive the bus. I'm just saying let's just think about that real quick. Philosophically, how do you feel about the fact that you're not writing the check? And we could do a back of the napkin calculation to figure out what that check looks like. But put aside the numbers for 1 second. We say to people, look, you're going to pass, your wife's going to pass, your husband's going to pass, the kids are going to get money. Kids are going to get a fair amount of money. And they're going to have to pay a little bit or some number to get that money. How do you feel about that?
Yep.
Right? And some people's answer is, for all the right reasons, they say, look, I want to make sure that doesn't happen.
Yeah.
That's real money. I think it's real money. I don't want to deal with it. I'd rather do other things. I might want that money to go to my kids. Okay. That's one answer without diving in any deeper than that. And then there's another answer to that question, which is, so I'm not paying it? Nope. I'm not writing the check. Nope. Doesn't come out of any of my money. Nope. Okay. I don't care.
Let them,
right?
let they're grown-ups, And
if the kids are going to pay $50 to get $1.5 million, or the kids are going to pay $75 to get $2 million, I don't know what the number looks like, whatever the number is, they don't even care about the number. They just go, look, it's not my number, it's their number, and they're still going to be ridiculously better off than I ever was. They're getting such a ridiculous head start. I don't care what the number is.
And if they've gone to a good estate planning attorney, their estate plan is wired-tight. So when it does happen,
right.
So when the inevitable does happen and the estate passes on to the heirs, your estate planner everybody knows what's going to happen, right? So if you've done everything right at this point, there's not going to be any surprises. And again, depending upon kind of the value of all the collective property when it's all said and done, that's what could potentially drive this, the potential estate tax that you have to. And so here's the important thing is that every case is going to be different. So there may be a situation where, and this is why planning and doing this, well ahead of time is so smart, because there may be a situation where let's say you have a gorgeous, beautiful house that overlooks the water and it's worth $2 million, right? And you have maybe $10,000 in the bank and you've been living off your Social Security and your pension.
Sure.
And that's what and your kids every weekend in the summertime and for, 2 weeks in the summer, everybody rolls up to your house and that's what you've been doing for the last 25 years. And it's been, what a great retirement, what a great,
Sure.
kind of sunset end of your life you've had. And it's time for you to move on, and you're passing on this $2 million house, and you really don't have a lot of liquid cash. So if the estate is entirely in this real estate, is in real estate, which is illiquid, this is where some planning, and again, it could be nothing more than just identifying everybody, say, hey, just so you know, in the estate plan, there's no cash to pay the potential estate tax that could happen. So, just so you guys know, you as the guarantor, the grantor of this, you may be like, hey, you guys figure it out, and it may require you guys, if you want to keep the house,
right.
if you want to continue to use it, you guys figure. I'm leaving it all to you kids, but you guys may have to kick in some money, and somebody may have more money than somebody else. I'll leave that.
Yep.
That's not going to be my problem to solve.
Well, you bring up a great point, right? Which is I certainly can take the I don't care approach.
Yep.
But that's exactly right. When you take the I don't care approach, that's the exact next question you want to ask, which is, by my not caring, am I leaving a bigger problem or am I leaving a problem? And how am I going to figure it out?
I don't look at it as an I don't care. I mean, I don't care. You know what I mean? Because I know what you're saying, right? You're not saying I don't care, the heck with them. It's I don't. It's more like I don't care enough to change. Why should I make some sacrifice or make some restrictions on in the twilight of my retirement, in order to pay something that is going to get sorted out, that they'll be able to figure out anyway, right? It's and that's the thing is people, and you're right. These guys will come in and they'll be like, hey, you got to do this. Because if you don't, oh my God, it's going to be the end of the world. Oh my God, you could have avoided part of this tax.
Right.
And you're like, well, yeah, I could have, but it also would have cost me X amount of dollars. It would have cost me X amount of time, right?
That's an excellent point. The other part of that is, if you want to make your planning not more complicated, but that's what you're doing, right? You're making it a little bit more complicated.
Right.
You do different things. Those things come at a cost, right? And some people will balance that off and say, look, is there an easy solution? What's the easy solution? What's the best way for me to handle this? Are there ways for us to do this? And there are. I mean, there are ways to solve that, $2 million property problem and figure it out so that it does. Yes, there are absolutely ways to do that. But you just, you to your point, you have to be willing to go through the extra hoops and to go through the extra planning steps and to make things a little bit more complicated. And some people just don't want to do it. I mean, it's not that they don't care. They just say, look, I don't see the value in that.
Right.
I don't see the value in that. And if somebody has to write a check, they're going to write a check, and there's plenty there for them to write a check from. And it's just not something that I'm willing to sort of entertain, making my life more complicated. I want to stay in control. I want to have access to all my assets. I'm not going to separate myself. I'm not going to put things out of my reach. I want to make it as easy for me while I'm alive, and it'll square itself up. And there's a lot that we can do to make things easy on the back end.
Yep.
It's not going to be complicated. It's just going to be that somebody will have to write.
But there's going to be work at the back.
Yep.
There's
no always work at the back
even
end.
if the best estate plan in the world,
Yeah.
there's going to be work, right?
Yep.
It's how it works, right?
Yeah.
But how many times have you seen when people and we've talked about this many times on the show where it's nice to kind of get everybody involved and to kind of in the sense of here's what mom and dad are going to do. We're not asking you. We're telling you this is what we want to do. We're not. This isn't a dialogue, as
That's
it were. We're not putting this out for a vote.
That's right.
This is how we're going to. This is what we want to do, and you guys are welcome to comment on it. But this is what we want to do.
Yeah.
But how many times have you seen where once kind of that, and we're not saying that that's bad because it's kind of important to do, but as you're starting to get, when the tax guys start chirping in your ear saying, "Oh, we got to do this. If you don't do that,
Right.
oh my God, you're so stupid if you don't make this move," and they start getting involved, and then you say, "Well, and you kind of open that door back to the heirs of the, then that may be something that you don't want to deal with.
Right.
You don't want to be like, because then they'll be like, well, listen, Dave makes more money than I make.
Yeah.
Why should I have to pay the same that he
Well,
pays?
you could be inviting some dysfunction where none exists.
Yeah,
Just by opening up the door on the front end. Yeah, absolutely.
And you know what? Back to the I don't care. It's maybe more like, I don't need to deal with this right now. I'm 85 years old.
Yeah.
You know what? The dysfunction's going to be there whether I'm here or whether I'm not, and I'd rather do it when I'm not
I'd rather
here.
avoid that. That's
Yeah.
right. That's right. Yeah,
Yeah.
that's right. So these, again, I guess the purpose of having the discussion this way is to say, there's a million reasons why somebody will try to justify. I mean, I get saving money is good, right? I get that.
Everybody wants to save money.
I get that not paying taxes or trying to avoid paying taxes. I get that benefit. I get all those things. I guess, but what I'm saying is some people truly, that's not what drives them. That's not part of it's not baked into their DNA. They understand it and they've paid their taxes their whole life. But at the end of the day, people have I think they have a different philosophy around when it comes to sort of legacy planning than getting a good deal on a new car, for example, where they feel like I'm experiencing this, I'm experiencing the benefit of reducing my taxes and paying less, and that's more money in my pocket. But when you get to this stage of the planning, and this is really about saying to somebody, how do you care? How do you feel? Or do you care about this part of the planning if it's something that you are completely unaffected by? I mean, do you care where your seats are for a baseball game that you're never going to attend? No, you don't care, right?
No.
This is potentially that same analogy, which is, look, I mean, I want to get to the game. I'll probably watch the game from home. I don't care where the seats are at Fenway.
I'll be listening to it in the car.
I don't care about it where it is at Fenway because I'm not going. And I'm not. I hope you have a great time, and I want you to go, and I hope you have fun. And I gave you the tickets, right?
Yeah.
But you're gonna spend some money when you get there, and I'm not going to worry about what you're going to spend because I gave you the tickets. This is the same exact thing. I gave you some money. You're going to pay some taxes on the money. But I still gave you the money.
That's a great analogy because let's say so you got 4 tickets, right? You got 4 tickets and 4 seats, and the seats are each seat has a different view, right?
Yep.
So you're gonna fight it. Are you gonna say, all right, Bob, you're sitting there, Billy, you're sitting there, Kate, you're sitting there, Joan, you're sitting right. You're not gonna say you guys can figure out where you're gonna sit, right? And you know what? There may be some arguments. I mean, if it's siblings, there may be arguments. But what I don't like, and I've seen this, time and again, is when you start talking about oh, well, here's how we're going to split it up, and here's how we're going to avoid the tax. What you do is you start inviting people to start thinking about their inheritance before it happens.
Well, that's exactly right. That's exactly right.
And then that's where kind of your dysfunction comes. Then where you're like, okay, so now people are like, oh, they and you as the person who's like, you're the older person, you're the parent, you're like, hey, listen, I don't need to deal with you guys arguing about my, asking about your inheritance, and then it could even go as far as if there's some liquid money, then people are like, well, why don't I take mine now and do this,
Well, I mean, think about it. That's exactly right. You're going to invite potentially, however many kids you have, right? You're going to invite that many opinions, right? You're going to invite that many personal situations into your life to deal with your decisions. Again, I'm not saying don't do it, right? Client is the boss. I'm not saying don't do it. I'm saying do it. I'm saying this is one of those considerations where now, do you really want to start making your estate and you are welcome to do this, right?
Yeah.
And again, you're the client. The client is always right. But you got to think about, do I want to bring in 3 or 4 different conversations, to your point, from people who say, well, I mean, if Dad paid those taxes now or did some planning now, I mean, that would be better for me because me, daughter number 1 or daughter number 4 or son number 2, I need more money. I like more money. And then there's another child who shares your approach for taxes, which is, we're still way ahead. Dad left us some dough, and it's going to put us way ahead of the game, and I'm not going to worry about it. I can't believe you're being so cavalier about Dad's money.
And that takes me into like the other tax which is involved, which is potential income tax on inheritance. So
post break,
we will go into that right after a short break here on Money in the Law with Jay Marsden from the Marsden Law Group. I'm John Drohan from Main Effort Financial, My FM 101.3. Don't go away. We'll be right back.
And we're back. On Money in the Law, My
jumped
FM 101.3, Jay
You jumped the
Marsden.
curb on that one.
Marsden Law, John Drohan, Minute for Financial. There's a monitor that you guys don't see here in the radio station.
That's a 1989 monitor, I think, too.
Yep, it's gigantic, and it records our voice levels on the radio. And so poor Ray comes in before the show and he asks us to give him some levels, and we give him some normal talking levels. And what he doesn't account for is the John Drohan excitability factor.
Stop.
And the John Drohan excitability factor knocks the levels outside of the bounds. And so we always try to say it's like coloring. The goal is to stay inside the lines. And so then we get all fired up about a topic like this, and next thing you know, the volume levels are spiking all over the place.
It comes back to enthusiasm upon delivery.
Christian's pulling his headphones off because we're so loud. It's like blowing his brains out like it is right now. So
Christian has some hearing damage.
That's what we're looking at here in the big box.
He's not even listening to us right now. He's wired in right now.
He's got the earbuds on.
He's watching like TV. Like he's got an iPhone taped to the back of that camera right there.
He's watching The Office.
Yeah,
that's right.
He's watching New Girl, which is my new show. We'll get back to the tax money. We'll talk about that.
Yeah, we'll talk about that later.
All right.
Go, Zoe.
So we went to. We were just before the break. We were talking about the other kind of tax that's involved with with estate planning, which is income tax, right? So, and where would you see income tax? Well, you'll see income tax if part of your estate plan you're leaving a qualified product, a qualified lump sum money. When I mean qualified, like an IRA or a 401k, something that has never been taxed before, right? So. Oftentimes, this could be a considerable amount of a person's estate in that it's their retirement. So if it's an old 401k or an IRA rollover, this money has never been taxed before. So, and now, as it passes, so again, we talked about the spousal, the unlimited spousal exclusion. So if Jay and I are married, if we were married, and I died and I left him my IRA.
Sure.
He could make it his IRA. Although I'm much older than he is. Actually, I'm only 3 months older than he is. So it wouldn't have any significant tax effect on. We were both born in the same year. So in that case, it doesn't matter. There's no taxable event.
There's no income tax to me.
And so then it becomes Jay's IRA, and Jay's IRA. He has to distribute it once he reaches his required minimum distribution age. He has to take that IRA money out in accordance with his life expectancy. Now, when somebody dies and they're not leaving it to a spouse, they're leaving it to somebody other than a spouse, then that becomes a beneficiary IRA. So a beneficiary IRA has some different rules. A beneficiary IRA, the person has to take that money out within 10 years. And this is a new rule that was based on coming off the last year's tax changes, where in the old days it used to use what's called a stretch IRA, where if I inherited, like let's say I inherited like my grandfather's IRA, if I inherited this, then I could take it out according to my life expectancy.
Which is obviously much, much longer than 10 years.
Yeah.
Yep.
So, but now because the IRS say, hey, listen, we need to start collecting some of this. Because remember, and this is what we always tell our clients, is the reason that there's required minimum distributions, the reason that eventually the government's going to make you take this money out of that IRA is because they got to get paid on it.
Right.
Remember, they've never taxed this money. Remember, this money went in, let's say it went like, whether it was part of an IRA or a 401k, was in pre-tax. So this money, it's earned income. It's never been taxed. So the government's like, hey, listen, Uncle Sam needs to get paid on this money. Sooner or later, we're going to get paid.
Well, it's funny. Unless you study the industry, if you will, a lot of these investment concepts, if you will, or these investment ideas or these investment products, which is how the financial services world sees them as, are driven by the tax code.
Yep.
And they're driven by either changes that happen in the tax code or changes that happen in different aspects of the tax code. And so, for example, the Roth IRA, the idea that you could pull money out and pay all your taxes, that was developed because the government needed the money. And so the government said, well, we need some money now, so let's give everybody the idea to pull money out of their IRA. We'll fight the fight later about the money that we don't get now. But they needed to pay for things currently, so they basically said, let's take the money out now. Let's convince people to do this. And so people
give you the tax incentive,
yeah,
right?
They give you a reason to do it, and you do it. And for people, if it makes sense, right time, right place, you do it. So to John's point, these things happen as a result of changes that need to happen in the tax code.
So in the case of the IRA, so the inherited IRA, so it becomes the beneficiary IRA. So I inherit this IRA. I have 10 years to distribute this money. So, and remember, if it's...
Now, do you still have to take something out every year based on your life expectancy?
You have to, there's the formula is so long as you have, there is a required minimum distribution.
Right.
So you're required to take something out, but by the end of that 10-year period,
you got to empty it by 10 years.
You have to, it has to be empty.
So if you say, I'm going to leave it alone, I'm going to leave it as long as I can leave it, you're still going to be required to take a little bit out every year according to your life expectancy. And then at the end of year 10, if you've taken nothing out, you got to close the whole thing out. You got to pay all the taxes.
It's all got to come out.
Got it. Yep.
So the idea of and before the break we were talking about this. So we were saying how like if you're doing an estate planning and you have like the heirs are getting involved, I'm like, hey, well, wait a minute. You know what? Wouldn't it be better if Dad paid all the taxes right now? If Dad started to distribute this money for himself right now, paid the tax on it, so then I wouldn't be inheriting an IRA. I would be inheriting just a regular lump sum of money that's not pre-tax. It's not IRA money. So there's not that requirement that I have to distribute it over 10 years. I don't have to potentially increase my tax bracket, right? If it's a sizable amount of money. And so you run into these problems where they could be problems because it may not be the right thing to do, yet the heirs may be wanting to coach or wanted to kind of coerce the grantor into saying, hey, maybe you should do this now in order to benefit me on the back end.
Right.
And you know, if it's us and we're the ones who are managing this, I'll never have anybody take money out of an IRA before it's time. I mean, our rule of thumb is you pay the tax, push off paying the taxes as long as you have to.
Yeah, let it grow tax deferred.
Because it gets to grow. It gets to grow tax deferred.
Well, and I think the answer is, you know, again, with the whole concept of today's theme is estate taxes, income taxes, you know, so the idea of planning around it. And I think you bring up a great point, which is how involved or how invested, if you will, do you allow other people to be as part of your tax planning, right? I mean, you certainly could talk about it at the at the up here level, at the top level with just your tax advisor or your investment advisor and your estate plan attorney all together, and just have the conversation be with you or with you and your spouse, right? You don't have to involve everybody right away. You know the family dynamics, you know the players better than we do, right? But so you have that conversation, and then these are the types of things that we uncover, which is, you know, do you want to pay the taxes right now? Are we doing this to benefit somebody equally or somebody inordinately based on the way your taxes put together? There may be other suggestions. You know, we talked a lot to clients about, you know, does the entire IRA need to go to a surviving spouse, for example? You know, we've talked a lot about splitting that up. You know, if you get $1 million IRA, you know, does the $1 million IRA need to go to the spouse? Do they have enough money? Maybe half the IRA goes to the spouse. Maybe the other half goes to the kids.
Well, that's part of the plan, right?
That's right.
Part of that's part of your comprehensive estate plan. And say, look, okay, so if we do this, if you know, this is we want to, you know, let's say, you know, whatever we determined how we want to distribute this, and it may not be equal for reasons that you know that you've uncovered, right? You say, look, I get it. You know, hey, Dave, remember you sold that company and you made $80 million for it. So the Dad's $350,000 IRA rollover, that's not going to mean a whole lot to you. Yet your brother, it could mean, you know, so you may make that, or we talked about if you have disabled children, things like that. So however you're divvying it up, however it's going to get split up, that's when you take into consideration the tax thing, the tax implications of certain assets. That's where the important part of planning. That's the important part of including the tax, the concept of tax, and understanding what is going to be require me to pay income tax if I take it. Because oftentimes you'll see people, they'll be like, hey, all right, well, you get this account and you get this account, and you know that's $100,000, that's $100,000,
sure.
And that's even. But if one of them is an IRA and one of them is not an IRA, they're not equal. It's not the same.
No.
It's not the same money.
You're not leaving the same amount of money to people.
Yeah.
You think you are, but conceptually you're not.
You think you are, and then before when you had the stretch IRA, you could say, well, if I leave a little bit more in the IRA, that'll benefit you, but not necessarily. So have an understanding of like what the income taxation of your estate is, what is going to be required to pay income tax on. That's significant, but it's significant in the point where you don't want to get bullied into anything.
No, that's a great term, right? You don't want to get bullied into a solution that might seem great for the person suggesting the solution.
Yeah, and oftentimes it's the heirs that suggest, well, Dad, if you do this,
and then obviously that's a money-driven conversation that says, look, we don't want to give up, the $500,000 split between two kids, $250, and in your grand scheme of things, if you're leaving them a couple $1 million and you say to yourself the taxes aren't that big, they may be hot to trot on the $250. They might be like, well, why? That's going to pay for somebody's college education. Why am I going to pay it? And again, we've said this a million times. If you don't think that somebody, I don't know who it's going to be, and it's not necessarily everybody, but somebody who's near and dear to you or close to you, they've done math in their head, right?
Yeah.
They have a ballpark idea of what they think mom and dad are worth, or
Yeah.
a ballpark idea about what auntie or uncle or grandpa or grandpapa are worth. They've done the math in their head. And you need to sort of understand that, look, you drive the bus on this. And, don't let somebody talk you into some type of convoluted, more. Because, again, the more complicated these planning strategies are, the more they need babysitting.
Yeah.
And the more they're going to cost, first of all, which you may or may not care about on the front end. But then they really need to be babysat, because then if you've based it around a very targeted tax law at a particular time, and that tax law changes, then you got to make sure that you're kind of on top of the fact that it needs to be changed again because something's different, or your family dynamic is different. And so,
and the timing of it, right? Like, the different phases in different people's life. If somebody's inheriting a beneficiary IRA under the old rule, where a stretch IRA is, if I'm 24 years old and I inherit an IRA and I have to take it over the course of my life expectancy, I'm not going to do any damage. I'm going to do minimal damage to that IRA, because I'm not going to be required to take that much money out.
Yeah.
Yet, if I'm 24 years old and I have to empty that IRA within 10 years, that puts me to 34. So that changes how that is going to, the approach on that. That changes. It could be a 24-year-old that's not ready to get that kind of money. It's not ready to be able to to handle that kind of asset. So
and if your portfolio is very retirement account heavy, which most people's portfolios tend to be, the planning becomes even more difficult, because the only way for you to actually do something with that is to pull the money out and pay the taxes, and then it kind of it creates this tax on tax cycle, which you may you have to really sort of think through a little bit and say, well, do I want them to just get the money as retirement money? I don't have to worry about it. It's a headache, but they're going to get it, and that's up to them.
So the idea is this. I think Jay and I collectively is that when you look at when you're approaching your estate plan, you have to take these things into consideration. You have to understand them. You have to understand, and this is what a good planner is going to do. They're going to lay it out for you. They're going to say, all right, here's potentially what you could be paying in an estate tax. Here's the income tax implications, But also they're going to put it into perspective, and they're going to say, right, so let's say, for example, you have $2 million of real estate, and you have $500,000 in an IRA, and you have $100,000 in liquid cash or something along those lines. So you've got some liquid money, and you have some real estate. So at the end of the day, the conversation may be just this: say, look, we could do some kind of some moving and shaking, and do some trust work, and maybe some ILIT or some kind of thing where we could lower your estate tax potentially.
Sure.
We could
potentially
lower your estate
snapshot
tax.
in time right now, yes. Maybe.
But at the end of the day, if you did nothing, here's what your estate tax most likely is going to be. If something happened tomorrow, here's what your estate, and then if we project out, conservatively, here's what we think it's going to be. You have money over here that could pay for it. You have liquid assets, so you don't have to sell any property. No one has to do anything like that. No one has to come. No heirs have to come in and give their own money.
No one's borrowing money to do this.
Yeah,
that's right.
They don't have to like go get a home equity line to do anything. Like the estate tax can be paid. The estate can be settled, and when the estate's settled, here's what remains.
Here's their net number.
Here's what remains, and guess what? They're going to inherit IRAs, which they're going to have to start taking money out of. Okay, is that the end of the world? Absolutely not. If you inherit an IRA, you have to start taking money. Wow, what a coincidence.
Well, we've said this in the show a million times. You're paying taxes because you made money.
Yeah.
Right? That's good. That's good.
And
right?
even if it's a large enough amount of money where it's going to put you to a higher tax rate,
right,
then that's the price of doing business.
Well, that's right. Congratulations, you've been successful.
Yeah.
Congratulations, you're somebody who left you money, right? As an heir, they were successful and thought enough of you to leave you more money, and now that you've inherited it and you've paid the bills and you've squared it all up. Now let's make you some money. Let's do something with that so that it squares up. So that the tax, again, If the taxes are important, or if the avoidance of the taxes are important, there's strategies for that, and your advisors will sit down and sort of guide you accordingly. But at the same time, if you are of the mindset that says, I'm just not that worried about it because somebody is still way ahead and I just don't feel like solving that problem,
Right.
Go. You have just freed yourself from the concern. Don't worry about it. Understand that that's your mindset. Understand that that's exactly why you're doing what you're doing. And don't give it a second thought. Move on and say, look, I'm going to you can always do lifetime gifting. You can always change somebody's life.
That's what I was going to say.
You can always change somebody's life in a lot of different ways that involve you being an awesome individual and changing the trajectory of somebody's life that don't necessarily have to involve convoluted, over-the-top estate planning concepts that somebody, that really can't pull out, grasp, and they just feel like it's being, kind of pushed on them or they're kind of bullied into it. There's a ton of ways for you to do awesome things.
It's kind of like an a la carte menu, right? So you as the, when you go to your estate attorney, you say, all right, what can I do to minimize my, and he'll be like, all right, well, if you do this, which is really easy to do, then your estate tax will go down potentially by this much. If you do this, which costs this amount of money and is a little trickier.
We can start. We can start in ways that aren't very complicated and accomplish your objectives, and we can then really dive into the deep end of the pool if need be. But it's not an all or nothing. It's not all or nothing.
And some people it may be important to them.
Yes.
And if it's important to you, just like anything else, then of course, then do everything that you can. Do everything that you can in order to provide the best estate or the most estate that you want to pass on to your
flexibility.
heirs.
We say this all the time. It's about flexibility.
That's
What's the way for us to develop a plan for you that's the most flexible, that you feel comfortable about, and that you feel good about, and that helps you not lose sleep at night?
And we're two, guys are pretty flexible. I mean, I don't know about you. I mean.
Oh, downward facing dog all day long. Yeah, sure. The crow, piece of cake, no problem. Warrior.
It's like, instead of Java with J, it's yoga with J.
Could be.
Yeah.
Could be. Nobody wants to see that.
Nice. All right, we're done.
We're great.
All right, we're time to break free. Everybody, continue on with your Saturday. Hope you have a great rest of your Saturday. And great
For
rest
those of you just waking up, you can check this out online. You can download it after the fact.
Rich Glenn.
That's right. You can download it after the fact. Watch it at your convenience.
Rich probably caught the last 10 minutes. He didn't hear us say his name in the beginning.
On a good day.
All right. So we'll see everybody next week on My FM 101.3, Money in the Law. He's the Law. Jay Marsden from the Marsden Law Group. I'm John Drowan, Main Effort Financial, Hollis and Cable Access TV. We'll see everybody
Have a great
next
one.
week.
Be well.